So let's work through a financial statement review. So there are 4 different financial statements, and there's a certain order that they have to be prepared in. So the first financial statement is going to be your income statement. So this is going to be your revenues minus your expenses to help you find your net income or your net loss if you lost money during that time period. So the first thing that you need to do is prepare an income statement. And then after you prepare an income statement, then you can prepare an owner's equity statement. So this financial statement is going to show the changes in owner's equity over the course of a time period, over the course of a month, a year, a quarter, whatever it is. So this statement just shows how your owner's equity changes and gives you a new ending owner's capital balance. Then, once you prepare an owner's equity statement, you can then prepare a balance sheet. So the balance sheet lists all of your accounts and their balances on a specific date. So the balance sheet is going to be the only financial statement that you prepare that's going to be for a specific date. It's a snapshot in time because it's just saying these are the balances of these accounts on December 31st. While the other 3 financial statements all talk about what has occurred over a period of time. And then the last financial statement is the statement of cash flows. Now, in chapter 1, you just need to know that the statement of cash flows exists and what it does. So this statement is just showing where has your cash gone and where did you get cash from, right? We just want to know what's happening with all the cash for a business. This is going to be a statement that you learn later on in your accounting classes on how to actually prepare. But you will need to know that it's one of the 4. It's the last one that you prepare, and it just sort of measures where your cash is going and where you got cash from. So those are your 4 financial statements. Now, we listed them in the order that they're prepared. This is going to be something that you'll want to learn, to memorize, but there's a reason why we're putting this in a specific order. So the first statement is your income statement. Well, you are going to need your net income or net loss in order to prepare an owner's equity statement. So there's no way that you could prepare an owner's equity statement without preparing an income statement first. Then, owner's equity helps us find that ending owner's capital, right? So that ending owner's capital balance from your owner's equity statement is going to show up on your balance sheet. So again, you can't prepare a balance sheet without first preparing an owner's equity statement. And then there's a bunch of different balances that you're going to need to compare and see when going from a balance sheet to a statement of cash flows. Just to simplify it, in this case, we're just going to say that you need your cash balance from your balance sheet in order to prepare a statement of cash flows. So they all work off of each other. So that's why when I say that you're going to need to memorize this order, I want you to do more than just memorize the order of 1 through 4 and instead understand the why, right? So we prepare an income statement to find our net income or net loss. And we need that net income or net loss to prepare an owner's equity statement. On the owner's equity statement, we find an ending owner's capital. We need that ending owner's capital balance in order to prepare a balance sheet. And then we need the cash balance on the balance sheet in order to prepare a statement of cash flows. So those are going to be your 4 financial statements. And there's different names for these statements. So you might see different names be tossed around if you go looking online for accounting help. But just know that these are the 4 that you're going to see in your book, in your homework, and on your exams. This is how it's going to be worded to you. So now we can work through this problem where we need to prepare a yearly income statement, owner's equity statement, and a balance sheet on December 31st, 2020 with the following information. So we have all of our different accounts here, right? We have cash, accounts receivable, supplies, equipment, accounts payable, unearned service revenue, owner's capital on January 1st, owner's drawings, service revenue, utilities expense, advertising expense, salaries expense, and rent expense. So we have a long list of accounts here, right? And we have everything that we need in order to prepare these statements. So the first statement that we're going to prepare is our income statement. So we have this shell, this framework of an income statement on our screen now. And let's just look at this first before we start plugging stuff in. So you'll notice that at the top of the statement, there's 3 lines. There's the income statement, right? That just tells people looking at your financial statements what statement they're looking at. So they're looking at the income statement. We have RD LLC, that's our company name. And then we have for the year ended December 31st, 2020. Now, this is where it could change. If we take a look back at what the problem told us, it tells us to prepare a yearly income statement. So we know that this is for the year. This is where it could say for the month ended December 31st. And in that case, we're just dealing with the month of December. It could say for the quarter ended December 31st, 2020. That's when we're dealing with the 4th quarter of the year. But just what's important to remember is that an income statement is for a period of time. So you're going to see something like for the year ended, for the month ended, something along those lines. Now, you'll notice we have 2 different sections of this income statement. We have our revenues and we have our expenses. Under revenues, we'll list all of our revenue accounts. Under expenses, we'll list all of our expense accounts. And then the bottom line of an income statement is your net income, right? And your net income we find by taking our revenues minus our expenses. So now we can start filling in this income statement shell. So the first thing that we want to do is take a look at all of our accounts and try to find our revenues. Right? So when we take a look at those account titles, we see 2 different accounts with the word revenue in it. Starting with unearned service revenue, and then we also just have service revenue. Well, unearned service revenue is a liability, right? Because we are liable for those future services. We have not performed the services yet. We have not done the work yet. So, unearned service revenue does not show up on an income statement. That's going to show up on a balance sheet later on. So the only revenue that we list on our income statement here is service revenue. Now, in certain problems, you might see a company have multiple revenues, right? There could be service revenue, sales revenue, rent revenue, a bunch of different types of revenue streams, right? So in that case, you would list all of those revenues, and then you would have to add them up and show your total revenues. But here, since we just have one single revenue account, we just list that account and we put its balance over on the far right of the statement. Now we have our expenses. So under service revenue, up in the upper right-hand corner, we have 4 different expense accounts. We have utilities, advertising, salaries, and rent. There's a certain way to list out these expense accounts. We're going to want to list them from greatest to least. So the first one is salaries expense for $8,000. And you'll notice that $8,000 is brought into the middle column, right? It's not as far over to the right as service revenue. And we'll talk about why in a little bit. But just notice that our expenses are being brought into the middle. So after salaries expense, the next biggest expense that we have is the $5,000 of advertising expense. Then the $4,500 of utilities expense. And finally, the $3,500 of rent expense. So we have our 4 different expenses listed out there, with their balances in the middle of the income statement rather than the far right. And here is why. The next line is our total expenses. So what we will do there is we'll add up our 4 different expenses. So we want to add up the $8,000, $5,000, $4,500, and $3,500. And when we do that, we get $21,000. And that $21,000, the total expense amount, is put over on the far right of the statement. So if we would have had multiple revenues, like we were talking about earlier, those revenue amounts for each individual revenue account would also be written in the middle, just like how we see with the expenses. So then that way, when someone takes a look at a financial statement for a company, they can just look down the far right side and they can see total revenues, total expenses, and net income. And if they want to see some more details on their different expenses and each of the different revenue streams, then they'll go into the middle and figure that out. But we want to make it formatted in a way that is going to be easy on the eyes, right? So here you can just look down the far right and see revenues and total expenses. So now we have $30,000 in total revenues and $21,000 in total expenses. Our net income is going to be revenues minus expenses. So we have $9,000 in our net income. So if we would have had, let's say, $31,000 in total expenses, we would have had more expenses than we did revenue. In that case, we would have a net loss. But here, since our revenues are greater than our expenses, we have a net income. So that's going to be our first financial statement, is the income statement. And so we'll definitely want to make note of that $9,000 net income, because like we said earlier, we're going to need that value when preparing our statement of owner's equity. So let's take a look at the framework here. The 3 lines at the top are pretty similar to what we just saw on an income statement, right? We have owner's equity statement. So again, just what financial statement are they looking at? We have our company name, RD LLC. And again, this owner's equity statement is for a period of time. And we were told that it was for the year. So we'll put for the year ended December 31st, 2020. Now, when we go line by line here in an owner's equity statement, the first line is going to be our owner's capital at the start of the year. Or if we were doing this for just the month of December, it would be owner's capital for December 1st, right? It's our beginning owner's capital. So here we want the owner's capital from January 1st because we're looking at the entire year. Then we have an add category and we have a less category. There's 2 different things that can go into each of those. So the 2 things that can be added on an owner's equity statement are investments and net income. So investments are when the owner puts money into the business, right? So if they were to invest into the business, that would show up as an investment here on the owner's equity statement. The second piece, the net income, that's what we just found on our income statement. Now, the 2 different pieces that can be included on the less category, or what's going to be subtracted here on an owner's equity statement, are any owner's drawings, right? So whenever an owner takes money out of the business for their own personal use, and a net loss. So you can either have a net income under the add category or a net loss under the less category. You're not going to have both, right? Because we're either making money or we're losing money. But those are all the pieces that can go in an owner's equity statement. And then we do all the math, and that will leave us with our owner's capital on December 31st, or our ending owner's capital like we were talking about earlier. So now we can start filling this out. Our owner's capital on January 1st, we were told that that balance was $40,000. So January 1st, 2020, owner's capital had $40,000 in that account. Then we look at the add section. We weren't told of any additional investments made by this owner. So if there aren't any investments, we don't need to even list investments here. But we did find out that there was a $9,000 net income. So we want to add that here on our owner's equity statement. And then we see the line underneath that 9,000. That means that we're going to have to do some math. So what we do is we take our beginning owner's capital of 40,000 and we add in the 9,000 of our net income. So it tells us that right now we're sitting at 49,000. So that's just a way just to update our numbers before we go into this less section of the statement. Now, under less, we know that that's going to be our owner's drawings or our net loss. But we definitely don't have a net loss because we just put our net income on this statement. So we take a look over at the account balances in the upper right, and we see that we have $7,000 of drawings. So when we subtract out that 7,000 from the 49,000, we can see that our owner's capital on December 31st is going to be $42,000. So we found our ending owner's capital balance. And that number, that 42,000, is going to be something that we need when we prepare our balance sheet next. So here's the framework of our balance sheet. Now, a balance sheet is a financial statement that kind of shows the accounting equation in action, right? It's assets equals liabilities and owner's equity. So in a balance sheet, we first list out all of our assets, and then we list out all of our liabilities and owner's equity. We find our total assets, we find our total liabilities and owner's equity. They need to equal because of our accounting equation. So let's take a look at the first 3 lines of our balance sheet. Once again, it's the financial statement that we're preparing, then it's our company name, and here, this is where a balance sheet is different. So when we take a look at an owner's equity statement or the income statement, it showed for the year ended December 31st, 2020. Because that statement talked about all the changes that happened throughout the year. A balance sheet is saying these are the account balances on this date. It's not about what changes happened, but rather just this is where we're standing now. Then you'll notice that assets have to be listed. And assets have to be listed in a specific order. It's called the order of liquidity. So the order of liquidity is how quickly you can turn an asset into cash or how quickly you're going to use up that asset. So we have 4 assets given to us in this problem. We have cash, accounts receivable, supplies, and equipment. Well, the most liquid asset always is going to be cash, because cash is already cash, right? So you can turn cash into cash pretty quickly. So we list out cash for $20,000. Then the next most liquid is going to be your accounts receivable, because we expect to be able to collect that accounts receivable typically within 30 days. So that 10,000 there, we're looking at that as if that's going to turn into cash within a month, right? So we see that as a pretty liquid asset. Then we have 2 more assets listed here in this problem. We have supplies and we have equipment. Now, equipment is stuff like machinery and computers and delivery vans. That's going to be more of a long-term asset. If you purchase machinery for your company, you're not expecting to use up that machinery and have it be all used up and go away quickly. So we look at equipment as more of a long-term asset. While supplies, if you use up or if you purchase office supplies for your company, you expect to use up those office supplies pretty quickly. So supplies is going to be listed next here in the order of liquidity, because we are going to be using up our supplies much quicker than we are the equipment. So we have our assets listed in order of liquidity. We have cash, accounts receivable, supplies, equipment. Then we need to find our total assets. So what we'll do is we'll add up those 4 balances, And when you add up those four balances, you'll get $71,500. So the asset section of the balance sheet is now complete. And we can move on to the second half of this balance sheet. So on the second half of the balance sheet, we need to list out our liabilities and owner's equity accounts. Now, under liabilities, we had two different liabilities in this problem. We had accounts payable, right? That's whenever we owe someone else money, and unearned service revenue. That's when we get paid for services in advance. So we owe those people future services. Here, we're just going to list them from greatest to least. So accounts payable of $20,000 and unearned service revenue of $9,500. Now your total liabilities will be your accounts payable plus your unearned service revenue amounts. So your total liabilities in this example are $29,500. Now owner's equity. So owner's equity is that umbrella, just like liabilities or assets, that encompasses capital, drawings, revenues, and expenses. Now, we don't want to list all of those here on the balance sheet. Here, we only will list our owner's capital. And the reason behind that is because our new owner's capital amount that we found on our owner's equity statement brought into account those other three pieces of owner's equity. It brought into account revenues and expenses when we added in the $9,000 of net income. It brought into account owner's drawings when we subtracted out the $7,000 in owner's drawings. So here, we only want to list our owner's capital on December 31st, which we found on our owner's equity statement to be $42,000. Now, a common mistake here would be to just go up and grab that $40,000 that we see given to us as our owner's capital on January 1st. But remember, that was January 1st of 2020. That was 365 days before we are preparing this balance sheet. This balance sheet's being prepared on December 31st of 2020. So our owner's capital amount has changed since January 1st, so we want to show the new updated owner's capital amount here on our balance sheet. So for your final line of the balance sheet, it's going to be your total liabilities and owner's equity. So what we need to do here is we need to take our total liability amount of $29,500 and add in our owner's capital of $42,000. And we see that we end up with our total liabilities and owner's equity of $71,500. Now we also see that same number as our total assets. And again, that's not a coincidence, right? Our assets must equal liabilities plus owner's equity. So if you fill out a balance sheet, right, and your total assets and your total liabilities and owner's equity equal, chances are you filled it out correctly. If they don't equal, you definitely need to take a step back and figure out what you did wrong. My first recommendation would be to double check for just a math error, right? When plugging in numbers, you might have plugged in 29,000 instead of $29,500 for your total liabilities. And that would have totally messed up your math when you were figuring out your total liabilities and owner's equity, right? So check for simple math errors first. If things are still incorrect or if things aren't balancing after you check for those, then you might have to go back and figure out, okay, did I make a mistake on the owner's equity statement? Or did I make a mistake on the income statement? Right? And just work your way back until you find that error. So that's the balance sheet, right? And then we would take these balances and use these balances to prepare a statement of cash flows.